So no capital raise, guys, which has been speculated by some analysts.
What are your expectations for energy then as a percentage overall? Will it continue to increase in terms of the overall percentage of profits of the company?
Guys, I don't know if you've had a chance to try it out, but I use FSD now on my way into work, across the Golden Gate Bridge through city traffic, and it's kind of amazing how quick.
It's going to be likely more a stripped-down version of the Model Y and Model 3, which could really put those models at risk.
All that and more. So let's get to it. Tesla stock is neither up nor down in the pre-market, currently sitting at $250.74. It's been a wild ride for TSLA as it is down year to date about 35%. But if we go back an entire calendar year, TSLA is up over 50%. It would appear TSLA has found some support in this mid-200s level. Or is this resistance? I don't know where the hell TSLA is gonna go in the short term, but long term, I have a decent idea. The legacy financial news media has had some time to digest this earnings, and much like the bears that put puts on the stock, are quite perplexed by where TSLA has gone since that dismal earnings call. Let's check it out.
Well, we're keeping an eye on shares of Tesla, of course. They are rallying today, despite what was a not particularly strong quarter when it came at least to hitting analyst estimates for whether it's revenues or the company's bottom line. Phil LeBeau's here. He's got more on what is sending those shares higher today. Phil.
It's the optimism that some of the benchmarks that were set out there, David, by Tesla yesterday and during the conference call, that they will hit those. Let's talk about that roadmap. Now, these are not huge benchmarks that are out there, but they are important ones, the most notable being that a lower-priced model will start production in the second quarter. When we see it actually go on sale, what it looks like pricing, that remains to be seen. The Robotaxi rollout is scheduled for June. Let's be clear. We're not talking about the Cybercab. We're talking about fully self-driving Model Ys in Austin, Texas in small numbers. That'll start in June. And Tesla said yesterday that its guidance for all of 25, they're going to pull it for now. They'll update when they give their update on the second quarter. And we should make it clear. Most analysts believe when you look at full year deliveries, they are likely to be considerably lower than what they were last year. Remember, in the first quarter, deliveries were down 13%. A number of analysts are forecasting deliveries for the full year to be down 10% compared to last year. Again, we'll get an update in the second quarter. And the most newsworthy headline to come out of the conference call yesterday was right off the top when Elon Musk talked about pivoting back towards Tesla and away from his duties with the Trump administration.
The big company update that all of the Tesla fans were looking forward to was just what we pretty much already knew. Elon Musk was going to divert some of his attention away from Doge. With the Robotaxi launch for Austin in June, this comes at a perfect time, I guess. But let's not forget, Elon Musk wears many hats. And he's done so for quite some time now. I am not going to question this man's logic on where his mental energy should be spent. But if this lip service keeps the stock from falling below the support level of 200, I suppose I'm all for that as well. As for the roadmap, there's going to be many questions about these newer, cheaper, more affordable models. Stripped down Model Ys and 3s, compacts, who knows what the is going to be produced. Austin Robotaxi in June, on track, and they're going to give up guidance in Q2? Let's get this straight, ladies and gentlemen. They've got their annual shareholder meeting, their Q2 earnings call, and a Robotaxi launch in Austin. Production of cheaper, more affordable models happening all around the same time? Sounds like a bunch of potential catalysts to me, ladies and gents.
One more note from Tesla's call yesterday. The company said it does have enough cash on hand to fund the products that are on its agenda in terms of whether it's the new lower priced model or future products that they are planning on building. So no capital raise, guys, which has been speculated by some analysts as a possibility. At least for now, Tesla says no need to raise capital.
Why you have a buy in the stock? Why?
Well, one, I think that what Elon has built and done and kind of moving to vehicles with a lower cost basis is, and on the energy side of the business, that's something we really like. And I think that people underestimated energy. And I think, quite frankly, last night was an example of that, where 14% of revenues, 25% of profits, which showed some resilience. So everybody knows that the auto side of the business has been under pressure.
Yeah, I noticed from your coverage list, it's not a surprise you might be focused on the energy business, given you do focus on a lot of those companies in that general industry. We haven't talked that much about it. Obviously, a lot of the enthusiasm seems to be around robots and auto and robot taxis as well. What are your expectations for energy then as a percentage overall? Will it continue to increase in terms of the overall percentage of profits of the company?
Sure. I mean, listen, it does have tariff exposure. So that is a vulnerability here. But if you do get a de-escalation, we have said that the return on invested capital of Tesla's energy business is better than any of their other businesses from our perspective. And I think we're seeing that bear fruit. Our analysis revealed that the need for mega packs and battery storage is far greater than most expect, largely because the variability that renewables have pushed onto the grid, both domestically and abroad, has created a lot of problems. And so to fix some of those problems, you will see a need for more battery storage. So we're very bullish on that. In fact, I'm out here on the West Coast at an energy conference with a lot of policymakers here. And, hopefully, we'll see. But I think what you're probably seeing is some capitulation off of a bottom. The resilience, might even see some short covering that's driving this. But I think the resilience from energy is definitely the highlight.
Don't sleep on the energy side of Tesla's business. This variability that renewables has caused on the grid, I'm not sure about all that shit. But the need for battery storage to stabilize grids, not just domestically but abroad, that's a real need. I think about the pressing need for data centers to progress artificial intelligence in the proper way. Using Tesla's megapacks to not only stabilize the grid but provide emergency backup power to these facilities, it'll start looking more and more attractive as we head our way towards the end of the decade. Energy being 25% of revenues? Yeah, you ain't seen nothing yet.
Elon Musk in the Tesla call last night reiterating his plan to launch paid driverless robotaxis in Austin by June. Also out with some big promises, including 99% Robotaxi market share and 10 million autonomous cars on the road in just a few years. After they're going to start slow, it sounds like. Deirdre Bosa has more in today's Tech Check. Deirdre.
Big ambitions, but Sarah, Elon Musk has long overpromised and underdelivered on the robotaxi front, so it can be difficult to sort through the hype. But now we looked at the data, and it is showing that he's getting closer to his goal while still, far behind Alphabet's Waymo, the current leader in the space. But I want to show you this chart from a crowdsourced website frequently cited by analysts.
Crowdsourced website? Are they talking about the FSD tracker?
It shows that Tesla's full self-driving system has sharply improved over the last year. Miles to disengagement climbing steadily, and the percentage of drives without a single disengagement, that has climbed to nearly 80%. And this is a major leap from where the system stood even a year ago, and helps explain, maybe even better justify, Musk's enthusiasm and ambition on the call last night. He was asked about Tesla's robotaxi strategy versus Alphabet's Waymo, which currently has a commercialized fleet delivering over 200,000 rides a week. But he brushed off the lead, painting Waymo as the expensive, over-engineered bet, and characterizing Tesla's strategy as the street-smart, fully AI-driven upstart ready to deploy millions of cars through just a software update.
200,000 rides a week? That's not half bad. I imagine a year from now, that number will decline precipitously as Tesla will scale, dwarfing them in availability, capability, and that most important metric of all, price. Don't get me wrong, ladies and gentlemen, I think Waymo is nice. I've never been in it myself, but not having to ride in the car with a stranger sounds pretty cool. But don't get it twisted. Tesla's going to be able to do it much, much better than they can. Simply because they figured out a generalized way toward autonomy that doesn't include expensive sensors like radar and LiDAR. And oh yeah, they produce their own vehicles. Try the technology for yourselves, ladies and gentlemen. I can't stress that enough. But be warned, once you do, it'll be tough to go back.
In other words, Musk is betting that scale beats precision and that software, not sensors, is key to winning the race. But it is far from a straight shot. We talk about some of these factors, like other competitors, Amazon Zoox, Baidu in China making big strides. Even if the software is improving, Tesla still faces big questions around safety and oversight. There's also regulatory hurdles, buy-in from the public, stats on safety. For investors, though, maybe worth comparing valuation as well. Much of Tesla's is wrapped up in hopes that Tesla's Robotaxi fleet will go beyond the just 10 to 20 Model Ys in Austin this June to cybercabs, to, as Musk says, 10 million cars on the road and counting. Now compare that to Waymo, which was last valued at just about $45 billion. That's a fraction of Tesla's market cap. The gap between aspiration and execution, that is what investors are betting will close, and very quickly. There's still a long way to go, but the statistics, the data is interesting, guys. I don't know if you've had a chance to try it out, but I use FSD now on my way into work, across the Golden Gate Bridge through city traffic, and it's kind of amazing how quickly it's improved over the last year.
It was a quarter that was a little bit better than people feared. It's why the stock is reacting positively. Elon turning his attention back towards the company, a little bit away from Doge, is also pretty constructive. The company's miss was really driven by higher SG&A and R&D spending, which is reasonably controllable and has to do with investment in future products and opportunities. So I think a lot of investors viewed that as a reasonably constructive miss, if you will, and an investment in the future.
Interesting. So all of that said, your new price target is 305. We've seen a couple of upgrades, I think, after the numbers last night. In the rate 350, that's out there. What do the numbers say to you is doable for this company?
So, I think when we look at volumes, which I still think are pretty important for the company, they're probably going to be down in about another 1 to 2% this year, and growth will only be reestablished with new products. And I think this is really a key part of the story. And we upgraded the stock to a buy in April of last year, downgraded in January this year, largely because we thought a lot of the hype around the new product was in the stock. But I think the news last night, there was one real sort of negative nugget, at least from my perspective, is that the new low-cost product is going to come out by the middle of this year. But the reality is it's going to be likely more a stripped-down version of the Model Y and Model 3, which could really put those models at risk, and it's really not what we thought was happening. And Elon also talked a lot about not needing to have a lot of new product, and sort of an analogy for Nokia phones versus the iPhone, and the iPhone was something that's had a pretty static form factor over time, and he kind of alluded to not the need to really introduce a lot of new product. And I think that's kind of a real miss relative to what's needed in a consumer retail business.
It's no surprise that an automotive analyst is focusing on the automotive side of the business, but like I've said before, if you're looking at Tesla as a pure battery electric vehicle manufacturing company, you're missing a significant portion of what this company is all about. Needless to say, the company seized an opportunity to further advance their autonomous efforts. Tesla's full self-driving software drives better than me, so I'm going to engage it every time I'm in the car, simply for self-preservation. Long story short, would I like Tesla to sell more vehicles? Of course I would, but that takes an extreme backseat to what truly matters, and that's solving for a generalized autonomous solution all over the globe. Once that's achieved, you can do whatever the you want, because you're gonna have revenue coming in per mile instead of per car. It's gonna take these analysts a bit of time to come to grips with that reality, but trust, change, it is a-coming. In conclusion, the financial news media has no idea what they're about to see in the next year or so. Their shock at how Tesla isn't on the decline after this earnings call is going to pale in comparison to when it leaps off the launching pad and heads straight to the moon. That's all I've got for you today. Be easy. Peace.